Welcome to DaveWise Capital. I'm Tanay, and today I'll be walking you through one of the most important shifts happening in global finance, how bond markets are changing in 2025, and what that means for investors like you. We will talk about why bond yields are rising, how central banks and government budgets are playing a role, and how you can make smarter investment decisions in today's environment. The bond market used to be considered slow and predictable, but not anymore. Big government spendings, ongoing inflation, and central banks pulling back from supporting bonds have made the space more active and uncertain. We are now seeing changes in how government borrow money and how investors respond to long-term financial risk. And these changes are affecting interest rates, currencies, and overall market behavior. Let's start with Japan. Recently, the country struggled to find enough buyers for its long-term government bonds, something we haven't seen in decades. While most of Japan's debt is held within the country, the Bank of Japan owns a large share of it. But now, the central bank is slowly stepping back from buying bonds, and this has caused the yields to rise. On top of that, the Japanese yen has weakened, leading to concerns from the US and other trading partners. So Japan's central bank is now stuck between two bad options: support the bond market and risk a weaker currency, or let the bond yields climb and face higher borrowing costs. The central bank buying government bonds was once seen as a solution, but now it's under fire. While this policy helped keep the interest rates low, it also led to distorted market signals and weaker currencies. In Japan's case, the yen is now very undervalued, and that's a warning sign. The bigger issue is whether central banks can keep supporting the bond market without losing investor trust. And for many countries, it looks like the support may no longer be sustainable here. Now, let's shift toward the US. The US deficits have been around for a while, but investors are now more worried about it. With debt passing over $34 trillion and interest costs rising, people are starting to question how sustainable is it. The 10-year bond yields are going up, partly because of inflation concerns, but also because of uncertainty in government policy. Political divisions and increased government spendings during an election year aren't helping. Markets are finally saying it's time to take the debt more seriously now. So, the question is it a good time to buy US bonds? Maybe yes in short term, because sometimes, near the end of financial quarters, investment funds shift their portfolios more towards fixed income side, which can help push the demand for bonds. Also, inflation-protected bonds, called TIPS, are offering real returns over 2%, which is solid if you want to protect your money from an inflation. But in medium-term outlook, it does not look as positive. Inflation is still sticky, and there is not much political will to reduce spending. So while there are chances to make money, you need to be very careful and strategic. On the other hand, Canada is usually seen as a responsible country when it comes to spending, but their reputation might be at risk. The government is planning to spend more on infra and defense, which could increase its deficit. Right now, Canadian bonds offer lower returns than US bonds, making them less appealing to international investors, unless Canada can prove its economy is strong enough to support the added debt. If the country starts to look more like parts of Europe, where high spending does not lead to strong growth, investors may start asking for higher returns or higher yields to hold Canadian bonds. On a global stage, we are seeing that bond markets are becoming less forgiving. Countries that do not manage their finances well are facing backlash. For example, the UK experienced a bond market sell-off in 2022 after releasing a budget that investors did not like. That caused the borrowing cost to shoot up and even led to political changes. The message here is very clear. Countries with poor financial planning will pay the price in higher yields and lost confidence. As we look through 2025, investors are keeping a close watch on how governments manage money, spendings, and growth. So, what can you do as an investor in today's bond market? First, spread your investments across different countries. Don't rely just on one government to manage things perfectly. For example, focusing on emerging markets such as India and Brazil. Second, focus on short-term bonds to give yourself more flexibility. Third, consider inflation-protected securities like TIPS. They can help maintain your purchasing power. Fourth, stay updated on policy announcements and economic data. Central banks' decisions can move market very quickly. And most importantly, be ready to adjust. Today's bond market requires more active decision making than it did in the past. If you were to have any questions, please feel free to email them and I will try to get back as soon as possible. And if you would like more insights on markets, policy, and strategy, follow us and stay connected. Thanks for watching.